Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to the show. This is episode number 249, the Retirement Portfolio Playbook with Hanlon, CFA. Hello, Connor. Welcome back to the show.
Good morning. Thank you.
We're happy to have you here. We're happy to talk about the Retirement Portfolio Playbook. For everyone who's watching and listening at home, I, again, am subbing in for Jake, or pinch hitting here and hosting the show as him and Rachel return from their travels. We're excited to hear more about the trip, and I'm sure, and I trust that they've enjoyed themselves. But again, it's Connor and I again this week, and we're going to talk about the Retirement Portfolio Playbook. But before we get into all of that, Connor, what's going on in your life? What's new with you?
Just had a big Memorial Day weekend, lots of family time. My sister came in from Chicago, so it was good to see her. So just getting back into the flow of things after the long weekend.
Sure. Good. It really is it certainly has become, I think, the unofficial or maybe even official kickoff to summer seemingly. So I'm glad to hear that you guys had a good time, get to spend it with the family. And I know that you guys were, I think, out at the lake, get to spend some time out on the water, hopefully. Good. And I coincidentally was in Chicago, where your sister was in town visiting from. I have a brother that lives there and has for 10 plus years now. So my wife and I went up to see him for the long weekend and enjoyed the Chicago Memorial Day weekend. But that's good, Connor. And I appreciate you taking the time to come on the show here today. And what you and I have talked some before we started the recording here, and really in the last few days, about this specific subject of the Retirement Portfolio Playbook. And what we want the audience and our listeners and viewers, at home and out and about, to really kind of focus on here today is thinking through the big picture in the long term, and want to talk some more about the way that we go about approaching investing for clients, specifically clients that are in retirement or approaching retirement, because that's a big part of the clientele that we work with, and a big focus of ours has been retirement planning. But before we get into all of that, just as a quick reminder, make sure you're subscribed to the show. That's the best way to make sure you get updated when new episodes are published and come out. Give the show a thumbs up or a 5-star rating, of course, if you think it's worth it. We, of course, appreciate that, and it helps other people find the show. But that's really why we're doing this, is to help educate people and to explain what people's financial plan means to them. So with that being said, just to kind of get us kicked off here, Connor, in your words, let's talk about the relationship between someone's financial plan and their investment strategy. Can you just kind of speak a little bit more about that? What's the right way, from your perspective as the portfolio manager at Falcon Wealth Advisors, focused on investments for clients specifically? What is the best way to think through someone's investment portfolio and their financial plan?
Sure. Yeah. The first thing is we want to start with the financial plan, not the other way around. Right. So we want to get to know the client. What are their goals? What is their current situation? When do they want to retire? And we get all that information, and then we base the investment strategy on all that information that is specific to the client.
Yep, that's really good, Connor. That's exactly right. We need to start with the financial plan, because conceptually, the idea is, if we've designed the plan, we understand what the client's intentions are, we can ultimately use the investment portfolio to implement the financial plan. That's the best way to think about it for people, as far as the approach that we're going to take. We want to use the investment portfolio to implement the financial plan. And the reason that we do that is because everyone's goals are going to be different. And ultimately, what we aim to do at Falcon Wealth Advisors is standardize the service that we provide and customize the advice, so we can get specific with each individual client. And that's really why we start with the financial plan. So once someone's financial plan has been established, and we determine the appropriate way to implement the financial plan through their investment portfolio, there's a lot of steps that continue beyond that. And Connor, a lot of those steps are what you and the investment management team are involved in. And in the current market environment, we've talked about buying low and selling high. I think that's the holy grail of investing. I doubt anybody needs to write that one down, and they're familiar with it, but it's difficult for people to do. So Connor, why is it difficult for people to buy low and sell high?
It is difficult, and you have to take the emotion out of it, right? We get several questions, something like, why did you sell, or why did you trim that position? That's been, one of the best performers so far this year. Why would you do that? And, it could be for a number of reasons, but one of the likely reasons is that position, that stock has gotten to a valuation where we feel it's overvalued, it's a little bit inflated, and we see a better opportunity in a different position that we feel is undervalued, and we like that risk return profile better on that position.
Yep, that's really good. And I think what we're talking about, though, is that's partially just to focus on the short term, naturally, especially amidst all the volatility in the markets. People have been more dialed in and tuned in. So that's part of it. It's just to focus on the short term. But I also think that emotions and behavioral biases are one of the main reasons that people struggle with this. More specifically, fear and greed. They're powerful emotions. They can drive our decisions. Our goal and our intention is to remove those emotions from the decision-making process, but we're human, right? We think in linear terms. When things are doing well, we think they're going to continue to do well. When things are doing poorly, we think they're going to continue to do poorly. But the whole idea is if we're buying high when things are doing well and selling low when things are not doing well, that's the exact opposite of what we're really trying to accomplish. And that's also why when we zoom out and look at the big picture, we want to keep the focus on a multi-decade financial plan as opposed to quarter over quarter investment performance. And I think that, a lack of patience and discipline is another reason that people struggle with this. I mean, we know, Connor, that, patience and discipline are both required for investing. Otherwise, there's going to be the constant knee-jerk reactions to whatever's going on in the market. But we ultimately want to remove those emotions. We want to have a process and a strategy in place so we can take advantage of buying when things are cheap and selling when things are more expensive without it being purely based on what any of us think or what's happening in the market or whatever it might be. We want to be able to really implement that strategy and that approach so we can buy low and sell high for our clients. And really the way that we do that is through rebalancing, which, Connor, you alluded to that some in your comments just a moment ago, but can you just tell me in your words, how and why do we rebalance client portfolios? And maybe we should start with the how piece because we've talked about the why some.
Yes, let me start with the how piece. So we have a trading software that we can put every client's individual target allocation in there. So for example, 60% stocks, 40% bonds, just as an example. Mm-hmm. So if that allocation gets over 5% out of balance, say if it gets to 65% stocks, well, we will then initiate a rebalance with our trading software, which will likely in that example be trimming some of the stocks that have become a higher weighting in the portfolio, and then using those proceeds to buy bonds. So that's the how piece, right? And the why piece is we want to, like I said there, keep everyone diversified the best we can, right? Because if you have one position that, grows and grows and grows, it's also going to be growing as a percentage of that client's portfolio. And we don't want to have too much of that client's portfolio in one position. We don't want it to be concentrated.
Yep, that's really good, Connor. And I think that's a good explanation of how we go about doing this. And I think you highlighted how we have a trading and rebalancing software that we utilize to ultimately execute trades for clients. But in that, each individual client and their household has its own target, all the way down to the very specific security level. So you talked about that 60-40 blend in the example that we're using here for stocks and bonds. What we're talking about is getting down to each individual stock and each different type of bond that a client owns in their portfolio. We have a target weighting allocated to each of those. And ultimately, rebalancing between them involves periodically selling some shares of what's done well and buying some shares of what's cheap to get things back in line with their target weighting. Because ultimately, that target weighting is what we are and is where we're intending to keep the portfolio, because that's what drives the returns long term. So in some ways, I think for people watching or listening to this, while it almost might seem counterintuitive, right, to sell investments that have performed well and buying those that have underperformed, rebalancing offers a lot of benefits, and it helps to remove some of the emotion from the equation. So
Yeah,
that's really good,
and it
Connor.
helps keep the financial plan on target as well.
Yes, exactly. That's exactly right. And I think that the last few years are a perfect example of this for people. We've seen a number of stocks have disproportionately impacted broader market performance. And the idea is, if you're invested in the right companies when they're doing well, that's great. However, it can leave you overexposed on the other end. So I think when we just take a step back and think about the retirement portfolio playbook, the reality is, for most of our clients, and most of the folks that we talk to and work with, if they're not already retired, they're approaching retirement, they've saved and earned the bulk of their earnings potential. And the reality is, the investment approach is going to be more about generating income and managing risk, as opposed to trying to absolutely 100% maximize appreciation, because there's a lot more risk that's involved in that. And most of the folks that we work with don't need to take that amount of risk. So
Exactly.
when we think that through, Connor, beyond that, we've talked about the target weighting. We've talked about how we want to start with the financial plan for someone, determine the appropriate balance between stocks and bonds. Let's take that a step further, and let's talk about, how do we determine the appropriate percentage to allocate to each different asset class? And I would just start by saying the asset classes that we're referring to, if folks have seen the Kalan chart or the quilt chart that we've showed, that shows, investment returns with different styles of investments, what's performed well and what's performed poorly year over year. That's what I'm referencing when I talk about styles. So large cap value, mid cap growth, and so on. So Connor, my question for you is, how do we determine the appropriate percentage that should be invested in each style on the Kalan chart for our clients?
Yeah, well, first and foremost, diversification. Diversification is the key, right? Because as we look at that chart you mentioned, whatever it is, large cap value, small cap growth, some different asset class is the best performer each year. We don't know what that's going to be. We can look at the historical risk return profile of each one and make an educated decision on what our target allocation should be. But we want to diversify as much as we can.
Exactly. And I think for all the reasons that we really just highlighted, in terms of who we work with and where they're at in their lives and what they're trying to accomplish. But I think the strategic asset allocation that we're talking about here, Connor, diversification is one of the benefits that comes from that. But it really involves establishing a target percentage of, based on long-term objectives, expected risk return characteristics of each different asset class. And then we ultimately are looking backwards and using historical data, going back nearly 100 years, to determine the appropriate percentage to allocate to each style, because we know that, historically speaking, there's more volatility, or there's more risk involved with small companies as opposed to large companies. So we take that into consideration when we're determining the appropriate percentage that should be allocated to each different style investment. But when we move beyond that, we can even take it another layer deeper, and we can talk about sectors inside of each style. So Connor, can you talk a little bit more about the sectors of the market and how we determine what percentage should ultimately be invested in each sector?
Yes, so we use the equal weighted S&P 500 index as kind of our framework for our portfolio. So we track that closely and try to model our sector weightings after that equal weighted S&P 500. But with that said, if we see an opportunity or a risk in one sector or another, we can drift a little bit and try to take advantage of that opportunity or manage that risk.
Yeah, that's really good. And Connor, can you just quickly give an explanation between, you talked about how we use the cap weighted index as a framework for how we build the portfolio for our clients.
Equal weighted, yes.
Yeah, or I'm sorry, I said, I just now said cap weighted. What I meant was equal weighted. Connor, can you explain the difference between cap weighted and equal weighted?
Yeah, so in the S&P 500, the equal weighted will use the same weighting, the same percentage of each company in that index, whereas a cap weighted goes on based off of the market cap of those companies. So Apple, for instance, would have a huge weighting in the S&P 500 cap weighted, but it would have the same weighting as every other stock in the equal weighted S&P 500 index.
Very good. That's a great explanation, Connor. Thank you for that. And I think that is also an explanation for a lot of people around maybe some of the headlines that we've seen or what we've read or seen recently through the market over the last couple of years is because when there are a concentration of companies that make up a much larger percentage of the index, how those handful of companies perform is going to more broadly influence how the index itself performs.
Yes.
So if there's a handful of companies that represent the largest percentage of the index in a cap weighted index like the S&P 500, those companies and their performance is going to impact how well that index does, more so than a portfolio that is going to be equally weighted, which is really the approach that we take. And Connor, let me ask you this question in your own words. Why would you say we take the approach of an equal weighted portfolio instead of a cap weighted?
Just because we want to do all the things that we've talked about already, manage risk and diversify, right? So some years you're going to have those top 5, 10 market cap stocks do really well. And sometimes you're going to have them do really poorly, right? But we want to spread our risk out and our returns out. So that's really why we take that approach.
Yeah, that's good. And I think just adding another layer to that or thinking about it a different way is so we don't have to be in the business of trying to predict the future. Because you talked earlier about how there's always going to be an asset class that's the best performer, but we don't know what that's going to be. Connor, you, me, Jake, anyone else can't predict the future. No one can. So I want to be clear on that piece. But by equal weighting the portfolio, that allows us to avoid having to try to predict the future. If we have an equal weighting to the appropriate sectors, to the appropriate styles, and a target return in mind and a target return determined for clients based on their financial plan, we ultimately build out the portfolio, and then we just need to execute the rebalances that we need to. We can make changes to the portfolio that we need to, but we're not trying to have an oversized percentage of the portfolio that we're managing for clients allocated to any one specific company, because that means that we're exposed. We have more exposure to any one specific company that can adversely impact the performance of the portfolio when the market's not doing quite so well.
Exactly. And then that's why we take that long-term approach.
Exactly. And I think that it is, we live in the world of the 24/7, 365-day news cycle. So there's always something to watch, always something to read, always something to pay attention to. We've seen through a lot of the discussions over the last few months in the market, there's all kinds of headlines that can move things around. And we, of course, are tuned in and paying attention, but we do want to take a step back because we don't want to have knee-jerk reactions to whatever's going on, or always trying to chase whatever the next shiny object is in the market, because there's countless stories in history of how that's turned out for people. And it doesn't mean that some of the largest companies in the world aren't going to continue to perform quite well. That's not what I'm suggesting here. What I'm suggesting is that the market has a tendency to misprice things in the short term and get prices more correct in the long term. So we don't want to get caught up too much in the short term and make decisions that could end up impacting the long term for clients.
Yeah, well said.
Okay, good. Thank you, Connor. So with that being said, how often should someone change their investment strategy?
Really, the only time to change your investment strategy is if your financial plan changes. If there is a life event or you're thinking, okay, I'm really liking what I'm doing, I'm going to push out retirement another 5 or 10 years. That might be a significant change to your financial plan and could affect your investment strategy. But otherwise,
no reason to make any changes there. Yeah, I think that's good. And I think the point there is that market conditions are not the driver for someone changing their investment strategy. The idea is we want to keep the long-term planning in focus. We want to continue to manage risk. It's important, I think, that people have regular reviews with their advisor to make sure that things are still on track, to talk about some of the life events, some of the things that change, because that really could be what spurs a change in the investment strategy, as opposed to what bond yields are doing or what tech stocks are doing or whatever else it may be in the market. We don't want the short-term gyrations to influence the investment strategy. We want to execute the investment strategy through good and bad times and make changes to it when the circumstances for the client change. Very good.
Exactly.
What, outside of that, Connor, when we think about the asset allocation, we think about this retirement portfolio playbook that we're alluding to. I think that one of the biggest changes for people particularly when it comes to their financial plan, is understanding where their cash flow is going to come from when they're not working anymore, when they don't have a paycheck anymore. And that's a big focus of what you and the investment management team work through. So can you just kind of give us some insight, Connor, into when we're thinking about generating income for clients in retirement, how they take distributions from their portfolio? Can you just give us some insights into how you and the investment management team kind of approach that or think about that from a portfolio construction standpoint?
Sure. Yeah. So on the equity side, it's not all growth stocks. It's not all one specific kind of stocks. We have a lot of dividend payers as well. And so we're getting dividends from all of those stocks. On the fixed income side, depending on someone's allocation, as they get further into their life, they may have a higher allocation to bonds to generate that income, that regular income, and then, take that out and live on it.
Yep, that's really good. And I think just conversely, the flip side to it is we've worked with clients that as they've gotten further into retirement and there's maybe less need for distributions from their accounts, where they've almost gotten more aggressive because the idea is their time horizon is actually even extending beyond their own lifetime. And for that reason, They'll approach it that way. So that kind of speaks to the investment strategy changes that we talked about, but also the insight into the way that we're approaching the equity portfolio, the dividends that stocks in the portfolio can generate, how we're laddering the fixed income or the bonds on that side of the portfolio. All of that is done in the efforts to manage risk for clients, to generate income so they can live off of their money and not have to worry about running out of it. Okay, very good, Connor. Any parting thoughts here? Anything else to add as far as the retirement portfolio playbook goes?
That's all I had. I think you laid it out pretty well. We don't want to be distracted by some of these short-term knee-jerk reactions. We're looking at this in the long term, just like your financial plan, and that's how we want to keep it.
Yep, that's really good. And I think just delineating the difference between a signal and just noise in the market, right? We know that this is relevant, but there's all kinds of noise all the time. But making sure that we're not reacting to that noise. We're taking it in, we're filtering it, but we're ultimately executing our approach for clients to help them achieve their target, to make their financial plan work. So if people are watching or listening to this, if they've seen activity in their portfolio, if they've seen trades that have occurred, oftentimes what we're doing is going through the process of rebalancing. Specifically, when there's a handful of companies in the portfolio that have done really, really well, we want to protect those profits. We want to bring things back in line with their target allocation because we don't want someone further out over their own skis is by the way of risk than they need to be at this point in their life. Very good, Connor. Well, again, I appreciate you taking the time to come on the show here today. I think we've pretty well covered everything. For anybody who's watching and listening at home, if you have any questions or if you'd like to talk through your investment strategy and your financial plan and the best way to make sure that things are aligned and that your portfolio is structured appropriately for retirement, just let us know. It's exactly what we're here for. My email address is just Cory@FalconWealthAdvisors.com. Connor's is Connor@FalconWealthAdvisors. Jake's is Jake. So that's ultimately all of us. All of us here at Falcon Wealth Advisors are here for all of our clients. So, please take advantage of us as a resource. We're happy to help. We trust that the episode we're putting out here today is helpful to think through what's the right way to invest when it comes for retirement and the approach that we're taking for clients. And we'll look forward to seeing you all next week. Connor, thank you so much.
Thanks, Cory.
All right.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, FalconWealthAdvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.